What the repo, adding a repo layer on top of that is genius, actually, because what a repo is where I need liquidity and I have U.S. Treasuries and you're the bank. I'm going to give my treasuries to you. You're going to give me funding and I agree to buy those back from you at a premium at some point, but I need the money in order to take care of things today and tomorrow. So if you're able to do that and use gold instead of U.S. Treasuries, which is one of the reasons you're seeing all of these countries sell U.S. Treasuries to stockpile gold. This is why guys like Vince Lanci says 85% of the gold that the central banks are buying is not reported to the IMF. Why would you? Remember, we saw Saudi Arabia getting caught reporting gold, or not reporting gold last year, and China, but they got caught by the import-export numbers. But in essence, you have gold which is outperforming the Treasury handily. It's doubled it over the last 25 years. It killed it last year by almost 10 times. It's killing it again this year. So when you talk about gold outperforming the Treasury but having no counterparty risk, it's almost a better vehicle than the Treasury if you have the rails. It would be massive. You know, it would add another layer to the things that we've been saying. So I've been talking about the expansion of the Shanghai Metals Exchange. Vince Lanci's been talking about that eloquently. Whereby they're building vaults in multi-jurisdictional areas, starting with Hong Kong, which is finished, where you can take possession already of gold in Hong Kong through the exchange of the digital yuan.
Yeah, I've got to interrupt there. One really cool thing about Hong Kong, everyone, it was pointed out by Mario and by King Kong as well, was that there's no capital limits. I received a card in the mail from Capital One a while ago. I showed it to the viewers saying Capital One is going to be clamping down and limiting how much you can move around through withdrawals or transfers of that sort of thing. It's for your protection. It's for your protection. And so these capital controls, but Hong Kong is free from that. Otherwise, people on the mainland of China, for example, have to apply for government approval before they can move large sums of money. Go ahead.
Right, so in essence, you have all of these vaults. The one in Hong Kong right now, you can take digital yuan and immediately convert it into gold and take it away. You don't have to convert.
The plan extends beyond Hong Kong. Multiple vaults situated across Asia, the Middle East, maybe even parts of Russia, all tied into a chain of gold storage capable of settling trade imbalances. Although the Saudi vault under construction has not been officially confirmed in all sources, analysts see moves in that direction. The goal is to allow countries to conduct trade using their own or digital currencies, settling in gold instead of dollars. Such a system undermines dollars' primacy and adds resonance to emerging multipolar financial infrastructure. Gold becomes more than reserve asset, it becomes settlement rail. Recent reports show central banks continue modest but consistent gold purchases.
The dollars first, and their aspirations then are to build a series of multi-jurisdictional vaults. The next one is under construction right now in Saudi Arabia. That is very significant because remember, Saudi Arabia was partners in Enbridge. They were the fifth partner, which is the cross-border settlement system. So it's significant in many ways, symbolically as well, that the second vault is being built in Saudi Arabia. The theory would be Saudi Arabia could sell its oil to China for the digital yuan. The digital yuan could then be just like that, converted into gold in one of these vaults, whether it be in Hong Kong where you take it or leave it there safely stored, or in Saudi Arabia, or in any of the other multi-jurisdictional vaults that will be built from parts of Russia, from all throughout the Belt Road Initiative, all over the place. They're going to do that, and they will connect with the vaults that were just built in St. Petersburg, in Moscow, in Singapore, in Dubai. They'll all connect. It is the ability to settle things outside of the dollar, to settle in gold, any imbalances, or all of it if you want. They're all going to connect. Now, what the repo, adding a repo layer on top of that is genius, actually, because what a repo is where I need liquidity and I have U.S. Treasuries and you're the bank. I'm going to give my treasuries to you. You're going to give me funding and I agree to buy those back from you at a premium at some point, but I need the money in order to take care of things today and tomorrow. So if you're able to do that and use gold instead of U.S. Treasuries, which is one of the reasons you're seeing all of these countries sell U.S. Treasuries to stockpile gold. This is why guys like Vince Lancy says 85% of the gold that the central banks are buying is not reported to the IMF. Why would you? Remember, we saw Saudi Arabia getting caught reporting gold, or not reporting gold last year, and China, but they got caught by the import-export numbers. But in essence, you have gold which is outperforming the Treasury handily. It's doubled it over the last 25 years. It killed it last year by almost 10 times. It's killing it again this year. So when you talk about gold outperforming the Treasury but having no counterparty risk, it's almost a better vehicle than the Treasury if you have the rails.
Traditionally, U.S. Treasuries have served as collateral in repurchase repo markets. But envision replacing or supplementing treasuries with gold, a collateral asset without counterparty risk, immune to many typical financial vulnerabilities. If countries can issue warrants, a kind of delivery ticket for gold stored in these vaults, they can use gold as collateral, getting liquidity without exposure to U.S. interest rate policy or currency risk. With concerns mounting about inflation, negative real yields, and the uncertain future of fiat reserves dominated by the dollar, gold starts to look like more than a hedge. It looks like leverage. Recent surveys show many central banks expecting to increase their gold holdings.
Of a Enbridge type platform that allows instant settlement in 7 seconds without the SWIFT interference at a 98% reduction in fees, where you can trade local currencies to do business with other BRICS countries and settle imbalances in gold through a multi-jurisdictional chain of vaults. Take that gold if you want, or let it store. And if you need a loan, in renminbi because you're going to trade with China and do whatever you want, and using gold as collateral, not only are you sidestepping the dollar, you're destroying the value of the U.S. Treasury. It is silent genius as far as I'm concerned. And by the way, a warrant, for people who don't really know, a warrant is basically just a delivery ticket. Give me my metal, here's my warrant. And that's the point of lowering interest rates. The Fed says we're going to lower rates. Trump wants lower rates, but they're really only able to really affect the front end of the curve, the overnight lending rate. Now, they've been talking about the hidden third mandate of the Fed that really is never talked about, where they could, if they wanted to, start to affect the back end of the yield curve. I'll get to that in a moment. But in essence, if the 10-year Treasury is what we're focusing on here, if these countries don't want to hold our 10-year Treasury, they sell it. The price of the bond goes down. Prices of bonds and the interest rates are inverse of each other. In other words, if everyone is selling and the bonds are falling in value because no one's buying them, interest rates have to go higher and higher and higher to attract more buyers.
Across many developed economies, central bankers and investors face a conundrum. Front-end rates, short-term funding, central bank targets may be eased, but long-term bond yields, the back end, are rising. Why? Because U.S. Treasuries and other government bonds are less attractive when inflation expectations eat into real returns. If investors anticipate inflation higher than yield, they avoid locking in long maturities unless yield compensates. Some governments are losing demand for their long bonds. Prices fall, yields rise. In this environment, gold, yielding nothing but offering inflation resistance and no issuer to default, is increasingly appealing. Data shows central bank gold demand surged, accounting for a large share of global gold demand, over 20% in recent years.
Conversely, if everyone's buying the treasuries like they used to, everyone's buying and buying, the demand is so high, rates go down because the demand is so darn high for these treasuries that, rates are going to start to fall. They move inverse of each other. So if everyone is now usurping the treasury market, not only not buying them and actually selling them like we've seen, then the bond prices fall and the back end of the treasury curve rises. We've seen this recently in the UK, where they've lowered rates on the front end. That's all they're really able to do, the overnight lending rate. They've lowered them like 7 times, yet the back end of the bond market, the 30-year bond that they have, is at or near all-time highs. In other words, the bond market says, you think you're going to lower rates right now? I mean, look at it this way. Right now, core CPI inflation, Dunnigan, is at 3.1%. That's a lie. We know it's a lie. John Williams of Shadow Stats would tell us it's add an 8 to that, it's 11%. But let's just play by their numbers right now. They tell us it's 3.1%, right? So it's 110 basis points above their long-term target.
We are witnessing more than gold stockpiling. Institutions, governments, even central banks are building alternatives to dollar-based settlement, digital currencies, cross-border payments outside of SWIFT, instruments like BRICS Pay, Enbridge-type platforms connecting banks directly, and vault networks tied into these. All these developments chip away at the transactional power of the US dollar. It's not just about holding reserves, it's about transacting, financing, and settling in gold or local digital currencies. The strategic value of gold vaults is amplified when paired with these rails. The physical, the digital, and the legal combine. Emerging markets seem especially interested.
Right? And so when you talk about Trump wanting to see the yield go down as low as 2%, right? 2%, they want to lower it by 200 basis points. They'd like to see that come down. At what point do the institutional traders say, oh, so let me get this straight. You want me to buy a bond that is actually paying a real negative return, lower than the real stated rate of inflation, the CPI. Forget about the make-believe where we know it's much higher than that, but the number that you're actually quoting at 3.1%, the 10-year is at 4. You want to see the 10-year as close to 2 as possible. So you want me to lend you money for 10 years at a 2% return when inflation, by your own BS calculation, is at 3.1%. I'm getting a negative real return of 1.1% per year compounding. No, thank you. And that will just accelerate the rush into gold. And ultimately what happens is that all of the intentions of the Fed to lower the back end of the bond market, they can't control it, because by lowering the front end, it betrays their ultimate goal is for lower in rates and higher inflation. It doesn't work that way. If you're going to have high inflation, then you need to have higher rates above the stated rate of inflation to attract buyers of your treasuries. So in essence, what one would expect, and we saw this last year, remember, they lowered the front end by 100 basis points or 1%. What did the 10-year do?
What does this mean for the future? First, the status of gold may strengthen, not just as reserve, but as pivot for trade, credit, and finance. If enough vaults are connected globally, settling trade imbalances in gold becomes viable. Second, markets will watch how many central banks continue buying gold, often quietly. Recent figures: central banks added about 10 metric tons in July 2025, led by countries like Kazakhstan, Turkey, China. Third, the euro has already been overtaken by gold as the second largest reserve asset globally. For nations, this shift offers greater autonomy against financial sanctions and dollar risk. It's a tipping point of financial systems evolving, and gold could play a central role.
When straight up commensurate, the bond market is an animal of its own and sees right through the fact that the Fed is cornered and trapped. Add on to this a repo market, substitute that is pegged to gold, in essence, using gold as collateral. It's genius. And the rails that they are building, not only the Enbridge rail, which they've already connected, the 11 Asian countries and the 5 Middle Eastern, just the 11 countries alone in Southeast Asia have double the population of the United States and already are China's #1 largest trading partner. 800 million people are trading. And then you add into it BRICS Pay, which people don't talk about enough. BRICS Pay is the B2B side. It's the retail side. They are now introducing it to the Belt Road Initiative. 75% of human population. They're rolling it out to everyone else except the US, the Euro, European Union, and the UK. Same thing with BRICS Bridge. So the BRICS Bridge, the Enbridge, that's central bank to central bank. BRICS Pay is retail. You're covering all of your bases, which is chipping away rapidly at the transactional status of the US dollar. And then the reserve status is getting beaten over the head by things like this, which will only accelerate the demand for gold in lieu of the US Treasury. In essence, if you don't see that things are massively changing, if you are stuck in this dollar-based, recency-biased, make-believe fairy tale, where it always used to be. You add on to the fact that no one trusts us anymore, and we're going around the world sanctioning punitively, tariffs, threatens, wars. We're at that point. The history books will talk about this point right now as, especially with the Genius Act implemented, as the beginning of something new. Don't know how it looks when it finishes, but I would say we are at that point right now where the table has been flipped almost completely over and things are going to start to change.